Hello and welcome to CandiMentor. Today we compare revenue rules across 4 major jurisdictions: United States, United Kingdom, United Arab Emirates, and Canada. We focus on how revenue is recognized, how indirect taxes change invoicing, how corporate tax environments impact profitability, and what regulators look for. Revenue Recognition Standard. The rule each country follows. United States. Revenue follows U.S. GAAP SC 606. It is the 5-step model. Identify the contract, identify performance obligations, determine transaction price, allocate, recognize when control transfers. United Kingdom. Companies applying UK-adopted IFRS follow IFRS 15. IFRS 15 uses the same 5-step model as ASC 606 with very similar principles. UAE, large companies and public entities use IFRS 15. The UAE does not have a local GAAP for revenue. They follow IFRS. Canada, public companies use IFRS 15. Private companies may use ASKE, but most large corporates apply IFRS 15. Takeaway: all 4 countries rely on the same 5-step model. Differences appear in interpretation, industry practices, and tax environments, not the revenue core. Indirect taxes that affect revenue billing and presentation. United States, sales tax. No national VAT. Sales tax rates differ by state and city. Sellers collect tax but do not include it in revenue. It is a liability. United Kingdom, VAT, 20%. Invoices show VAT separately. Revenue is recorded net of VAT. UAE, VAT, 5%. Introduced in 2018. Businesses record revenue net of VAT and recognize VAT separately as payable to the Federal Tax Authority. Canada, GST/HST. Federal GST at 5%. Some provinces combine GST with provincial tax to create HST with higher rates. Revenue is recognized net of GST, HST. Why this matters? Indirect taxes change the way the invoice looks, the way revenue is presented, and the way customers pay. It also affects system configurations and contract pricing. End. Corporate tax environments. How profits after revenue get taxed. United States, federal 21%, plus state corporate taxes that vary widely. Effective rates differ by state. United Kingdom, 25%. Main headline corporation tax rate. Some marginal or small profit reliefs may apply. UAE, 9% federal corporate tax. 0% for income up to AED 375,000. Free zones have special regimes but must meet qualifying rules. Canada, federal 15% plus provincial tax on top. Combined corporate rates commonly land in the mid-20s. Why interviewers care? Tax regimes impact pricing, transfer pricing, margin expectations, and business models. Market and industry context. How revenue patterns differ by country. United States. Large subscription ecosystem. Software and SaaS dominate. Complex multi-element contracts. Heavy state-by-state sales tax rules. United Kingdom. Heavy focus on services, consulting, banking, and cross-border trade. Revenue timing often touches multi-jurisdiction projects. UAE. Strong trading hub, logistics, e-commerce, construction, free zone rules. Revenue issues commonly include long-term contracts, cross-border services, and free zone qualifying income rules. Canada, resource-heavy economy, oil, gas, mining, forestry. Long-term production contracts and commodity-linked pricing influence timing of revenue. Insight. Once you know the industry mix, you'll know which areas of revenue get the most scrutiny. End. Disclosure and enforcement. Regulator attitudes. United States. SEC. strict focus on performance obligations, variable consideration, and contract disclosures. SEC comment letters are common. United Kingdom, FRC, focus on transparency and clarity in IFRS 15 disclosures. Strong oversight for listed entities. UAE, MOF, Federal Tax Authority, free zones. Strong focus on VAT compliance and on free zone qualifying revenue. IFRS disclosures still expected for financial statements. Canada, Provincial Securities Commissions and CRA, strict on revenue disclosures and on GST, HST accuracy in returns. Banks and financial institutions face heavier requirements. Cross-border practical issues, where companies get stuck. Issue 1. Currency and translation. Exchange rate movements create revenue volatility in Canada, UK, and UAE when billing in US dollars. Issue 2. VAT GST versus sales tax treatment. In VAT GST countries, tax is a pass-through. In the US, sales tax rules differ by state, affects invoicing and compliance. Issue 3. Permanent establishment rules. Cross-border services may create tax presence even if revenue is booked in a different country. Issue 4. Transfer pricing. Pricing between group companies must be arm's length. Revenue recorded locally may differ from global revenue before tax adjustments. Issue 5. Contract law differences. UK and UAE contract terms often include more formal written agreements. US companies sometimes rely more on purchase orders. This influences contract identification under the first step of the revenue model. Numerical examples. Hashtag example A. UK VAT 20%. Customer price £1,000. VAT £200. Invoice £1,200. Revenue recorded £1,000. VAT liability. VAT. Example B. UAE VAT 5%. Service fee AED £10,000. VAT AED 500. Invoice AED 10,000. Example C. U.S. sales tax. Sale price $1,000. Local sales tax 7%. Invoice $1,070. Revenue $1,000. Sales tax payable $70. These examples show how tax affects invoicing, but not revenue recognition. Boring. Interview cheat lines. Say these slowly. All 4 countries use the same 5-step model. ASC 606 and IFRS 15 are aligned in principle. Indirect taxes differ. Sales tax in the US, VAT in the UK and UAE, and GST, HST in Canada. Corporate tax rates shape pricing and profitability. For example, UAE is low tax, UK and Canada are mid-20s. US federal is 21% plus state. Industry mix drives revenue challenges. SaaS in the US. Financial services in the UK. Construction and trade in the UAE. And resources in Canada. These lines signal senior-level understanding. Practical checklist. Perfect for interviews or real projects. 1. Confirm which standard applies. ASC 606 or IFRS 15. 2. Identify whether contract prices are tax-inclusive or exclusive. 3. Determine performance obligations country by country for cross-border deals. 4. Map VAT, GST, sales tax rules to the billing system. 5. Reconcile accounting revenue to tax-reported revenue in each jurisdiction. 6. Document transfer pricing policies for intercompany revenue. End. Final wrap. 1-paragraph summary. Across the US, UK, UAE, and Canada, the underlying revenue model is consistent. Everyone uses the 5-step approach. But operational differences matter. Indirect taxes differ, billing rules differ, and corporate tax rates shape how companies price and structure deals. In interviews, emphasize the global consistency of the model. Then explain how each country's tax regime, regulator expectations, and industry landscape influence actual revenue reporting.